first thing most people see is a notification on their phone. Trading halted. The ticker of a familiar, supposedly boring bank is down 60% pre-market. Then a headline, regulators in emergency talks as deposits flee. In a matter of hours, what looked like a solid institution has gone from invisible plumbing of the financial system to front-page drama. Commentators say, almost with schadenfreude, they got liquidated. It sounds like what happens to over-leveraged crypto traders, not to a major bank. But the language is brutally accurate. The bank's assets are being sold off, its parts carved up, its shareholders wiped out. Underneath that one word, liquidated, is the entire story of how modern banking really works, and why, when a bank fails, it can shake everything from interest rates to the price of silver. To understand what just happened, you have to start with something deceptively simple, a bank's balance sheet. On one side are deposits and other liabilities, the promises the bank has made, especially the promise to give depositors their money back on demand. On the other side are loans and securities, the things the bank has bought with that money, usually long-term and illiquid. That maturity mismatch is the core of banking. Borrow short, lend long, and pocket the spread. It works beautifully in calm times. It becomes lethal when interest rates spike and confidence breaks. For more than a decade after the global financial crisis, interest rates sat near zero in much of the developed world. Banks grew used to cheap funding and predictable markets. Then, with inflation surging to levels not seen in 40 years, central banks yanked rates up at the fastest pace in decades. A slow-moving problem on bank balance sheets suddenly turned into a time bomb. Here's the uncomfortable fact. When interest rates rise, the value of existing bonds and fixed-rate loans falls. That isn't opinion, it's basic bond math. If a bank bought a 10-year government bond yielding 1% and rates jump so that new bonds yield 4%, nobody wants the old one at par. Its market value drops until buyers are indifferent between the low coupon old bond and the shiny new one. On paper, the bank is now sitting on losses. It still gets its interest and principal if it holds to maturity, but if it has to sell those assets today, it takes a hit. For years, large banks stuffed their balance sheets with long-duration government and mortgage-backed securities, judging them safe. Safe from credit risk, perhaps, but not from interest rate risk. Most of the time, that risk remains hidden. Accounting rules even allow many of these securities to be booked as held to maturity, meaning their temporary market losses barely show up in reported capital. As long as depositors leave their money in place, the bank never has to realize those losses. That's the quiet assumption that underpins the system. Deposits are sticky and confidence is stable, but confidence is a strange variable. It can hold for years, then evaporate in a day. And in the smartphone era, it evaporates faster than ever. Where a bank run once meant anxious customers lining up at branches, it now means billions of dollars moving with a few taps in online banking apps. When rumors spread that a bank is sitting on large unrealized losses, especially if its deposit base is concentrated and uninsured, it doesn't take much for nervous clients to start pulling funds. Imagine that sequence in miniature. A few large depositors, perhaps tech firms, hedge funds, or crypto exchanges, grow jumpy after reading a research note flagging the bank's interest rate exposure. One pulls a few $100 million, another follows. The outflows turn from a trickle into a stream. Word gets around in a tight-knit industry, and by the time the bank realizes what's happening, billions are on the move. To meet withdrawals, the bank first uses its cash reserves, then taps available short-term funding. When that isn't enough, it has to sell those safe securities whose market value has quietly cratered. Suddenly, the unrealized losses become painfully real. Each sale erodes the bank's equity. Traders see the capital hole widening and start shorting the stock. Ratings agencies downgrade, more depositors run. The doom loop is in motion. This is the essential paradox of modern banking. Even a balance sheet that looks solvent on a hold-to-maturity basis can be rendered insolvent if too many depositors demand cash at once. A textbook liquidity problem can become a solvency crisis in a single ugly week. Regulators know this, which is why they watch certain metrics obsessively: liquidity coverage ratios, capital buffers, the proportion of uninsured deposits. But they, too, are flying partially blind, relying on outdated filings and incomplete information. When the pace of withdrawals accelerates beyond anything their stress tests imagined, their toolkit shrinks to three options: provide emergency liquidity, help arrange a sale, or shut the bank and move it into resolution. What turns a wobbling institution into a major bank failure is not just size, but interconnectedness. It might be a bank deeply tied into the tech ecosystem, or one that served as a key on-ramp for a booming sector like crypto. It might be a globally active institution whose derivatives and funding links run through money markets, hedge funds, and corporations worldwide. When such a bank keels over, the fear is not just about its depositors, it's about what else breaks when its flows stop. That S, when the word liquidation leaves the world of spreadsheets and hits ordinary people, Businesses unsure if payroll will clear investors, wondering if their brokerage's cash sweep is safe. Savers asking whether their country's deposit insurance scheme can really handle a cascade of failures. By the time the weekend arrives, the bank's fate is sealed. Regulators prefer to act on Friday after markets close to buy time. Statements are drafted, bids solicited, emergency meetings held. Somewhere inside a conference room, advisors are combing through the bank's balance sheet, deciding what can be sold and at what price. The public will see a short, deceptively calm line in a press release. The bank will be placed into voluntary liquidation, or the bank has been closed and the Deposit Insurance Authority appointed as receiver. Behind that sentence is a brutal exercise, turning a complex leveraged financial institution into cash fast enough to meet obligations and contain contagion. That is what it really means when they say they got liquidated. And that liquidation, as we'll see, doesn't just smash the bank's shareholders and bondholders. It can also set off strange chain reactions in markets you might not expect, including sudden violent spikes in the price of silver. To see how the bank ended up here, staring down the barrel of liquidation, you have to rewind a few years, back to the period when free money felt permanent. Central banks, desperate to revive growth after the global financial crisis and later the pandemic shock, cut interest rates to zero or below and bought trillions of dollars in government bonds and other securities. That flood of liquidity compressed yields across the curve. For banks, this created a quiet but pressing problem. Their core business, earning a spread between what they pay on deposits and what they earn on loans and securities, was being squeezed to the bone. In that world, the temptation to reach for yield was almost irresistible. A bank sitting on a large inflow of deposits, maybe from flush tech startups, booming housing markets, or crypto exchanges, could either park that money in ultra short-term instruments yielding next to nothing, or extend the duration and lock in a slightly higher return. Many chose the latter, buying longer-dated government bonds and mortgage-backed securities. After all, these were considered extremely safe from a credit perspective. The U.S. Treasury doesn't default, and agency-backed mortgages carry an implicit guarantee. Risk managers flagged the interest rate risk, but the consensus story was soothing. Rates will stay low for years. If anything, they might go even lower. That story broke the moment inflation roared back. Trillions in pandemic stimulus, supply chain snarls, energy shocks, and labor tightness pushed consumer prices up at the fastest pace in 4 decades. Suddenly, central banks that had spent years trying to push inflation up to 2% found themselves staring at 7%, 8%, or more. Their response was a series of rapid rate hikes, 25 basis points, 50, 75, again and again. In bond markets, it was a bloodbath. Yields on 10-year government bonds, which had been languishing near 1%, surged to 3%, 4%, or higher. The corresponding price drop obliterated the mark-to-market value of long-duration bond portfolios. Banks that had chased a bit of extra yield were now sitting on losses equal to a large chunk of their equity. The numbers were stark. Public filings in early 2023 revealed that U.S. banks alone had hundreds of billions of dollars in unrealized losses on securities due to rising rates. That didn't automatically mean they were insolvent. Remember, if held to maturity, those bonds would still pay out at par. But it meant their ability to withstand a confidence shock was much weaker than it appeared from regulatory capital ratios. Regulators had tried to minimize this vulnerability after 2008 by pushing for more high-quality liquid assets. Ironically, those very assets, long-dated government bonds, became the vector of danger when the rate environment flipped. At the same time, deposit structures had quietly become more fragile. Many fast-growing banks attracted a clientele of large, uninsured depositors. Tech companies with tens or hundreds of millions in their operating accounts, venture capital funds parking dry powder, crypto platforms using the bank as a fiat gateway. In the U.S., the Federal Deposit Insurance Corporation, FDIC, insures deposits only up to $250,000 per depositor per bank. A corporate treasurer with $20 million in one institution knows that most of that money is exposed if the bank fails. In calm times, they accept the risk for the sake of convenience and relationships. In a storm, they run first. Combine those ingredients: massive unrecognized interest rate losses, a high share of uninsured, sophisticated depositors, and a social media-driven information ecosystem. Add one spark, a bearish analyst note, a leaked internal memo, or a prominent investor publicly advising portfolio companies to move their cash, and the fire starts. When early withdrawals force asset sales, the effect snowballs. A bank that might have survived if its securities book remained untouched is now bleeding capital with every sale. The market reacts brutally. Equity investors, smelling blood, dump the stock. Short sellers pile in. Credit spreads on the bank's bonds blow out. Counterparties pull back credit lines and demand more collateral. What was a contained balance sheet problem turns into a full-blown market confidence crisis. This is where the vocabulary of liquidation and margin calls starts to blur between Wall Street trading desks and the supposedly sober world of commercial banking. Just as a leveraged trader can be liquidated when losses exceed their margin, forcing their broker to close positions at fire sale prices, a bank can be forced into its own kind of margin spiral. As the market marks down the value of its assets and securities, its regulatory capital shrinks. Falling capital ratios trigger covenants and supervisory alarms. Regulators may demand remedial plans, capital raises, or restructuring. If the bank tries to issue new equity in the middle of a panic, it often backfires. The mere act of raising capital signals distress, and if the raise fails, confidence collapses further. Behind closed doors, the bank's management team scrambles. They may try to pledge high-quality securities to central bank lending facilities to get liquidity without selling. They might seek a private sector bailout, a consortium of stronger banks providing deposits or equity, perhaps sweetened by government guarantees. In some notable cases, bigger institutions have been pushed or persuaded to acquire the troubled bank outright, absorbing losses in exchange for expanded market share and backstop support. But these maneuvers depend on time and credibility, two things that are in short supply once the market senses a death spiral. The suspense in these episodes is very real for the people on the inside. They know that if they can just slow the outflows and survive a few weeks, they might ride out the panic. They also know that if deposit flight accelerates beyond a certain point, there will be no graceful landing. In the background, regulators are quietly stacking contingency plans. If a sale cannot be arranged by the weekend, the legal machinery to close the bank and transfer its operations into resolution must be ready. The difference between rescued at the last minute and then shut down and liquidated can hinge on details as small as whether one potential acquirer S-board meets on Thursday or Friday. Meanwhile, outside the narrow drama of this single bank, markets are watching for signs that the problem is systemic. Are other banks showing similar securities losses? Do they share the same concentrated uninsured depositor base? Are there hidden exposures through derivatives and off-balance sheet vehicles? Each new revelation can trigger a wave of selling across the sector. Exchange-traded funds that track bank stocks see massive redemptions. Credit default swap spreads on bank debt spike, a barometer of perceived default risk. Even if fundamentals at other institutions are stronger, fear doesn't discriminate. In that atmosphere, every rumor feels plausible. Once the balance tips and regulators decide that the bank cannot viably continue, the legal term liquidation finally enters in a formal sense. For some banks, the path is a straightforward receivership, with the deposit insurance authority stepping in, paying out or backstopping depositors, and auctioning off pieces of the business. For others, particularly those with international footprints or special charters, it might be a court-supervised wind-down labeled voluntary liquidation, even though the voluntariness is largely semantic. The essential act is the same: turn the bank's assets into cash or saleable units and allocate the proceeds according to the legal hierarchy of claims. By the time that decision is public, the equity is usually worthless, and junior bondholders are facing near total losses. Senior creditors may be haircut or made whole, depending on asset recoveries. Large uninsured depositors hold their breath, waiting to see whether regulators will protect them fully, partly or not at all. The normal hierarchy: shareholders lose first, then subordinated debt, then senior debt, then uninsured deposits, sometimes bends under political pressure, but it never completely disappears. Someone must absorb the losses that rising rates and poor risk management have crystallized. When commentators say they got liquidated, they are talking first about those investors and owners whose capital has been wiped out to plug the hole. And yet, for all the drama, this is only half the story. Because when trust in banks and fiat promises wavers, investors and savers look for somewhere else to run. That rotation, out of financial institutions and into perceived hard assets, can create violent moves in markets like gold and silver. When a major bank fails, it is not just bank stocks that can move in double digits. Sometimes silver itself can suddenly spike, driven by a complex mix of fear, speculation, and forced unwinding. Another kind of liquidation, playing out in the metals pits. When the announcement finally hits, it is almost deliberately dull. Today, Name of Bank announced that it will wind down operations and voluntarily liquidate the bank in an orderly manner. Or regulators have closed Name of Bank and appointed the Deposit Insurance Agency as receiver. It's the financial equivalent of a coroner's note, but if you peek beneath that bland phrasing, the liquidation process is anything but dull. It's a high-stakes triage effort involving lawyers, traders, regulators, and sometimes politicians, all vying to determine who gets paid, who gets wiped out, and which parts of the bank live on under a different roof. Start with the most politically sensitive group: depositors. In most developed countries, there is a formal deposit insurance scheme. The FDIC in the US, the FSCS in the UK, and equivalents elsewhere. These schemes guarantee retail and small business deposits up to a certain limit, funded by insurance premiums paid by banks and, in extremis, backed by the sovereign. When a bank fails, insured depositors are meant to have uninterrupted access to their money, either through a rapid payout or by having their accounts transferred to a healthy bank. The goal is simple: prevent a loss of confidence that could trigger runs on other institutions. The spectacle of small savers losing their life savings is the one thing politicians will not tolerate. Uninsured depositors, typically large companies, funds, and wealthy individuals, occupy a more precarious position. Legally, they are creditors of the bank, ranking above bondholders and shareholders, but below certain secured claims. In a textbook liquidation, they would receive whatever is left after higher-ranking creditors and administrative costs are paid, which could mean a partial recovery at best. In practice, regulators sometimes choose to protect them fully if they fear systemic contagion, as happened in some recent crises where systemic risk exceptions were invoked. This creates moral hazard, but it also preserves short-term stability. The tension between those two goals hangs over every major bank failure. Below depositors sit the bank's bondholders. Over the last decade, many jurisdictions pushed banks to issue a special class of debt explicitly designed to absorb losses in a crisis: bail-enabled MARs, bonds, contingent convertibles, COCOs, and other flavors of subordinated and senior non-preferred debt. The idea was to ensure that taxpayers would not bear the brunt of future bank rescues. Instead, private investors in these instruments would be bailed in, having their debt written down or converted into equity to recapitalize the bank. In a liquidation, these instruments can be wiped out almost entirely. Theoretically, investors in them were compensated for this risk with higher yields. In practice, many did not fully price in the speed and severity with which they could be zeroed. Shareholders, of course, stand at the very bottom of the hierarchy. By the time a bank enters formal liquidation, its equity is usually already trading at a fraction of book value, often in the low single digits as a kind of option on a miraculous rescue. When the closure is confirmed, that option is extinguished. Equity is written down to zero. For employees with stock-based compensation or long years of accumulated shares, this can be devastating. For institutional investors holding the stock as part of bank indexes or financials portfolios, it is another reminder that too big to fail does not always mean too big to wipe out. Inside the failed bank, an army of specialists gets to work. Resolution teams map every asset: loans, securities, derivatives books, physical branches, data centers, fintech partnerships, custodial businesses. Some pieces are eminently sellable. A portfolio of prime mortgages or small business loans might be snapped up by healthier banks at a discount. Wealth management units with loyal, high net worth clients are attractive targets. Even the branch network, with its deposits, customer relationships, and real estate, has value. Other assets are toxic and hard to move, such as legacy commercial real estate loans in troubled sectors, or complex derivatives positions with opaque counterparties. Derivatives are a special source of tension. Modern banks sit at the center of a dense web of swaps, options, and forwards used by clients to hedge rates, currencies, and commodities. Those contracts are governed by detailed legal frameworks, like ISDA agreements, that include provisions for what happens if one party defaults. In a bank liquidation, close-out netting kicks in. Counterparties can terminate contracts and set off what they owe against what they are owed. Depending on the net position, the failed bank's estate might receive cash or owe it. In stressed markets, these flows can be large and poorly anticipated, potentially turning a manageable wind-down into a scramble for liquidity. All of this is happening under acute time pressure. Regulators want the most systemically important functions, payments, clearing, custody, to be transferred or backed up almost immediately to avoid disruptions to the broader financial system. At the same time, they must be seen to follow the legal hierarchy of claims, to avoid lawsuits from aggrieved creditors and accusations of favoritism. The constant fear is that a misstep in one bank's resolution could shatter confidence in others. If bondholders in this case are treated unusually harshly, investors might start dumping similar instruments issued by other banks, raising their funding costs and perhaps pushing them toward trouble. There is another layer of suspense playing out more quietly: the hunt for hidden losses and misconduct. In the forensic autopsy that follows a major bank failure, regulators and prosecutors comb through risk reports, internal emails, and trade logs. Were risks properly disclosed? Did executives mislead investors or supervisors? Were there concentrated exposures that violated policy? In some past crises, such investigations have unearthed everything from aggressive accounting tricks to outright fraud. In others, the verdict has been more mundane but no less damning: reckless complacency, wishful thinking about interest rates, and a culture that rewarded short-term return on equity over long-term resilience. While all this unfolds, the broader market is digesting a message that goes far beyond this one institution. The era of cheap money has consequences. When rates were pinned near zero, leverage felt painless and duration risk benign. As rates normalize, or overshoot, the hidden fragilities in balance sheets are exposed. The bank that just got liquidated is a very public casualty of that transition. Investors begin to ask, how many others are in the same position but haven't yet faced a run? Which sectors are most vulnerable? Real estate-heavy lenders? Niche institutions tied to speculative industries? Shadow banks operating outside the regulatory perimeter? Those questions feed directly into cross-asset moves. When credit risk feels higher, investors rotate toward perceived safe havens. Traditionally, that means government bonds of strong sovereigns. But when the very institutions that intermediate those bonds appear shaky, some investors look further afield. Gold is the classic refuge, but silver often rides in its slipstream with a twist. Silver is both a monetary metal and an industrial one, used in electronics, solar panels, and medical applications. That dual nature makes it more volatile. In periods of acute financial stress, that volatility can cut both ways. But when fear of banking instability dominates, silver can see explosive upside as capital scrambles out of the regulated financial system into tangible stores of value. And here, the word liquidation appears again, this time on trading screens and metals markets. Leveraged players who were short silver, betting on lower prices, can be caught offside if a bank failure triggers a surge in demand for precious metals. As the price spikes, their losses mount, margin calls arrive, and positions are forcibly closed. Shorts are liquidated, buying back silver to cover, which pushes the price up further in a self-reinforcing squeeze. What started as a localized banking problem has now contributed to a silver spike, driven by a mix of safe haven buying, speculative momentum, and forced short covering. To understand why a bank's liquidation can coincide with a spike in silver, you have to trace the psychological and mechanical pathways that connect them. Psychologically, a major bank failure is a blow to trust in the modern financial architecture. Depositors are reminded that their money in the bank is, in legal terms, an unsecured loan to a leveraged institution. Investors are reminded that regulatory ratios and soothing executive commentary can mask large latent risks. Each scandal or surprise failure chips away at the perceived safety of paper assets and fiat promises. Historically, when confidence in banks or currencies wavers, precious metals benefit. Gold and silver are no one's liability. Unlike a bank deposit or a government bond, they are not someone else's promise to pay. In crises from the 1970s, inflationary shock to the 2008 collapse, demand for physical bullion and exchange-traded metals surged. Silver, in particular, has a history of sharp, disorderly moves. The Hunt brothers' attempt to corner the silver market in 1979-80 drove prices to extremes before an equally violent crash. In more recent years, episodes like the 2011 silver run-up and the brief 2021 silver squeeze, attempted by retail traders online, showed how quickly sentiment can swing. Mechanically, the link between banking stress and silver prices operates through multiple channels. One is the interest rate and inflation outlook. A bank failure caused by rate hikes can prompt central banks to reconsider their tightening path. If investors believe that authorities will respond to financial instability by slowing or reversing rate hikes, or even by reviving balance sheet expansion to stabilize markets, they often infer a more inflationary or currency-debasing future. That, in turn, increases the appeal of inflation hedges like gold and silver. The mere expectation of looser money down the line can move metals prices today. Another channel is the portfolio rebalancing behavior of large investors. Sovereign wealth funds, hedge funds, family offices, and even corporate treasuries hold diversified portfolios that may include bank equities, bank bonds, and other credit-sensitive assets. A shock loss on financial holdings can prompt a reassessment of risk. Some institutions, guided by formal risk limits or informal instincts, shift part of their exposure into hard assets. A 1% or 2% portfolio reallocation by large players can mean billions of dollars flowing into metals, both through futures and through physically backed exchange-traded products. Because the silver market is relatively small compared with global bond or equity markets, such flows can have an outsized impact on price. Leverage adds a further accelerant. Much of the trading in silver, especially on futures exchanges like COMEX, is conducted with borrowed money. A speculator might control $1 million in notional silver with margin of only a fraction of that. When prices move sharply, margin requirements can change rapidly. If a bank's failure triggers a risk-off wave, clearinghouses and brokers may raise margin on metals positions across the board, forcing traders to either post more collateral or reduce positions. If the move is upward, a silver spike, short sellers are squeezed hardest. Their losses grow, margins are called, and they are forced to buy back into a rising market. This is the cascading short squeeze dynamic, often labeled a liquidation cascade. On the flip side, some long silver positions can also be liquidated if broader market stress leads to cross-asset deleveraging. A hedge fund suffering losses in bank stocks or credit derivatives might be forced to sell winning trades, including profitable metal positions, to raise cash. In periods of extreme stress, this can temporarily push silver lower, even as its long-term safe haven appeal strengthens. The net effect depends on which forces dominate, margin-driven selling or safe haven buying. Major bank failures tend to tilt that balance toward the latter, especially if they feed a narrative of systemic fragility and future monetary accommodation. There's also a subtler linkage via mining and industry. Banks provide crucial financing to commodity producers, including silver miners. If credit conditions tighten sharply after a bank liquidation, with lenders pulling back from riskier borrowers, some mining projects may be delayed or canceled. Over time, this can constrain supply. While such effects unfold slowly relative to the instantaneous moves in futures markets, they can shape the medium-term fundamentals that traders and investors use to justify higher prices. In information terms, the headline "Major Bank Fails" acts as a powerful narrative catalyst. In the online investing ecosystem, where attention and emotion drive flows as much as spreadsheets do, stories of bank runs and liquidations quickly morph into broader themes. Fiat is fragile. Get out of the system. Own real assets. Precious metals. Evangelists amplify these narratives, sometimes with justified historical references, sometimes with exaggerated doom. Retail investors, already primed by years of social media content about monetary debasement and sound money, can pile in, buying physical coins, small bars, or silver-backed ETFs. Dealers report surging demand, premiums over spot widen, and anecdotes of shortages feed back into the bullish storyline. Critically, not all of this movement is grounded in fundamentals. Some is pure reflex, a kind of financial fight-or-flight response. In the short term, that can produce overshoots. Silver ETS volatility means that a spike associated with a bank failure may extend far beyond what a sober assessment of supply, demand, and monetary policy would justify. But markets rarely trade on sober assessments in the eye of a storm. They trade on narratives, flows, and positioning. A bank's liquidation, especially if it comes as a surprise, is the kind of shock that can upend positioning and send flows racing toward any asset perceived as outside the fragile banking web. At the same time, it would be a mistake to see every silver spike as purely speculative. Underneath the froth, there is a rational core, the desire to hold something that does not depend on the solvency of an intermediary. In a world where a blue-chip bank can go from solvent to liquidated in days because of duration mismatch and digital bank runs, that desire is understandable. Whether silver is the best vehicle for it is another question, but the emotional logic is undeniable. What makes these episodes particularly tense is that they blur the line between what is inside and outside the system. Large physically backed silver ETFs, for example, are themselves financial instruments issued by big institutions and settled through banks and custodians. Futures positions are deeply entangled with the very clearing and margin infrastructure that rests on banks. So even as investors flee banks to buy silver, they are still, in many cases, trusting a different segment of the same system. If the crisis worsened enough to threaten those pipes, the meaning of safe haven would shift again, perhaps toward direct ownership of physical metal held outside financial intermediaries. By the time the silver spike is front-page news, with breathless commentary about record demand and shortages, the initial catalyst, the bank's liquidation, may be fading from view. The failed bank's assets are being quietly parceled out, lawsuits are being filed, postmortems are being written. But in the markets, the aftershocks linger. Price charts now show a jagged upward lurch coinciding with the date of the bank collapse, a visual reminder that credit events in one corner of the system can reverberate into seemingly distant assets. And investors, whether they participated in the move or merely watched, are left with a gnawing question. If one major bank could be liquidated so quickly, how many other hidden fault lines are waiting to snap? After the immediate drama fades, the emergency press conferences, the weekend negotiations, the volatile trading sessions where bank stocks plunge and silver soars, the deeper implications of a major bank liquidation begin to crystallize. At heart, such a failure is a stress test of the entire financial regime born after the last crisis. For more than a decade, policymakers told the public that the system was safer, more capital, more liquidity, tougher supervision. When a supposedly well-regulated bank still blows up because of interest rate risk and concentrated deposits, it raises uncomfortable questions about what those reforms missed. One lesson is about the limits of models. Supervisors and banks alike rely on stress tests that simulate adverse scenarios, recessions, credit losses, funding squeezes. But models are built on historical data, and history offered few recent examples of the kind of regime shift that occurred when inflation surged and rates were hiked at breakneck speed. Assumptions about deposit stickiness, asset correlations, and central bank responses turned out to be fragile. The bank that got liquidated was not alone in making those assumptions. It was simply unlucky or imprudent enough to combine them with a business model that left no margin for error. Another lesson concerns the speed of modern crises. In the 1930s, a bank run played out over days as lines formed outside branches. Even in 2008, wholesale funding markets took weeks to freeze and counterparties to pull away. Today, social media can spread fear to millions of depositors in hours, and mobile apps let them act instantly. A single viral message from a respected investor can trigger billions in outflows. The regulatory apparatus, built for a slower era, struggles to keep up. Tools like emergency lending facilities and deposit guarantees still work, but they must be deployed faster and with more nuance than ever. Each delayed or clumsy communication can worsen the panic. For investors, the liquidation exposes a structural tension that has always existed, but is now impossible to ignore: the trade-off between yield and safety. When rates were near zero, many were pushed into riskier assets, longer duration bonds, high-yield credit, equities, to earn any return. Banks themselves, as we've seen, were not immune to that pressure. As rates rise and some of those positions sour, the hidden leverage and duration exposure in the system come to light. A major bank failure is like the tide going out. You see who was swimming naked, but you also see who was relying on the illusion that someone else, regulators, central banks, implicit guarantees, would always be there to cover their risk. The silver spike, viewed in this broader context, is not just a speculative aberration. It is a symptom of a deeper discomfort with that trade-off. On one side are assets that promise yield but carry complex, often opaque risks: bank stocks, subordinated debt, structured products. On the other side are assets that carry no yield but are simple in their essence: a bar of silver, an ounce of gold. When a bank gets liquidated, it's a vivid demonstration that the search for yield can end in zero. For some, that makes the zero-yield certainty of a physical asset more attractive. Yet there is no permanent equilibrium here, only cycles. If policymakers respond to banking stress by cutting rates or expanding their balance sheets, the immediate fear may recede, bank stocks may recover, and the silver spike may partly retrace. Memories of the crisis fade. Investors drift back toward yield. Banks, chastened for a while, tweak their risk models and disclosures, but eventually find new ways to stretch. The system evolves, but its core dynamic, leveraging short-term confidence into long-term promises, remains. Each cycle writes another chapter in the long story of money, credit, and trust. The unresolved suspense after a major bank liquidation lies in two questions that no one can answer with certainty. The first is, was this an isolated failure or the first domino? In some periods, like the U.S. savings and loan crisis of the 1980s, the failure of one interest rate mismatched institution presaged hundreds more. In others, a few high-profile collapses were contained, serving as cautionary tales without igniting a systemic conflagration. Analysts scour balance sheets, macro data, and policy signals, trying to place the current episode in one of those categories. Markets oscillate between complacency and alarm as each new data point arrives. The second question is more existential. How many times can the system rely on extraordinary interventions before public trust erodes beyond repair? Each time, regulators invoke systemic risk to protect uninsured depositors. Each time, central banks open emergency liquidity spigots or expand guarantees, they prevent immediate collapse. But they also reinforce the perception that rules are flexible for the powerful and that the game is rigged. That perception is fertile ground for alternative monetary narratives, from cryptocurrencies to gold bugs to advocates of a return to some form of metal-backed money. Silver, with its historical role as coinage and its tangible industrial uses, sits at the intersection of those narratives. In that sense, the phrase, "they got liquidated," carries a dual meaning. On the surface, it describes the legal and financial fate of a single institution that mismanaged its risks. On a deeper level, it hints at the possibility that certain assumptions about perpetual low rates, about the infallibility of modern risk management, about the self-correcting nature of markets, are themselves being liquidated, repriced by reality. Each bank failure, each flight into silver and other hard assets is a small vote against those assumptions. Standing back from the screen, you can see the outlines of a larger pattern. A long era of suppressed volatility, engineered by central banks, is giving way to something more jagged. Interest rates move in larger steps. Inflation is less predictable. Geopolitical fractures complicate global capital flows. In such an environment, both banks and investors are more exposed to policy mistakes and shocks. The failure of a major bank, the liquidation of its positions, the spike in silver, these are not random, isolated blips. They are signposts along the road from one monetary regime toward another, still uncertain destination. Whether that destination is a modestly reformed version of the current system or a more radical rethinking of money and banking will depend on choices made in the aftermath of these crises. Will regulators genuinely grapple with interest rate risk, digital age bank runs, and the boundaries of deposit protection? Will investors and depositors internalize the lessons of leverage and concentration? Or will the next cycle of complacency start as soon as yields stabilize? And when the next shock hits, as it inevitably will in some form, will the response once again drive frightened capital into silver, producing another dramatic spike? Those questions will be answered over years, not trading days. In the meantime, the story of this particular bank's liquidation has joined the canon. A cautionary tale told in risk committees, investment memos, and late-night conversations among traders watching metals tickers. Somewhere on a price chart, a sudden vertical line in silver marks the moment fear jumped from bank ledgers to commodity pits. And for anyone paying attention, that line is more than a curiosity. It's a reminder that in a world built on layered promises, the boundary between the solidity of a vault and the shine of a silver bar is far thinner and far more fragile than most care to admit.